If you're worried about the stock market in 2022, and many people are, one of the best ways to hedge against risk is to buy strong companies that are undervalued with a good future outlook. I'm Jonathan, and we're going to look at why I believe AT&T, ticker symbol T, is one company with that potential in today's edition of Constant Cash Flow. We can see that AT&T fell from its high of $32.63 in May of 2021 all the way down to around $22 in mid-December, a drop of 30%. It's since recovered a portion of that loss in the last month, gaining back $4 of its $10 share price degradation. Now, one of the potential appeals of AT&T stock has always been its dividend. If we pull up Seeking Alpha, we can see that right now their dividend yield sits at 7.9%, which is great, but also not as attractive if you expect it to keep falling like a rock from the heavens. And just because the dividend stock's a good buy for one investor doesn't mean that it's a good buy for all investors. So stick around to the end where I reveal which investor this could be the right choice for. Ultimately, the goal of any investor is to make money. So let's dig in and see what the outlook and the numbers tell us. Of course, most people are aware that the big news over the last 6 to 8 months with AT&T is that it's spinning off its Warner Media business and merging it with Discovery. But besides just knowing that it's taken place, it's critical that we understand how this deal works if we want to make an informed decision about whether or not to invest in the company now. But first, I want to give a quick shout out to two recent subscribers, Sergio Mildner and Finance Club. Thanks for subscribing and all the great comments. I love the interaction. If you're new to the channel and want to have a chance to be included in an upcoming video as well, make sure to subscribe and comment "I subscribe" down below. Now let's get busy. This is AT&T's current business. They're moving their Warner Media division into a brand new company. And Discovery, which is composed mainly of two segments, U.S. networks and international networks, is moving their entire company into the newly formed one. If we take all of the 2020 revenue for the segments being moved, we have this new breakdown. As you can see, Warner Media will account for about 3/4 of the newly formed company. The whole premise behind this merger is that when combined, they would now be able to cross-leverage their power and reach. They'll have many more offerings together and should be better equipped to compete with other streaming platforms such as Netflix, Amazon, and Disney. In order to understand exactly what this means, we need to look at what each company gets for the deal and how it's structured financially. First, for Discovery shareholders, 100% of their investment goes into the new business. Their shareholders will receive 29% of the new company. For AT&T shareholders, they'll receive the remaining 71% of the new company. If we own AT&T shares today and we hold them throughout the entire process, which is expected to be finalized sometime in the middle of 2022, we would have shares in AT&T and we would receive shares in the new company. One important thing to consider is that since Discovery is being completely absorbed by the new company, this new company will end up with about $15 billion in debt from Discovery. They could also have around $43 billion in debt from AT&T. There are three main scenarios in which this could play out. First, this debt could be moved from the AT&T company to the new company, and even though it's technically a move on paper, it's like getting a cash boost of $43 billion for AT&T itself. AT&T has also stated they may receive some debt securities as part of the merger. What that means is they would essentially be the debt holder for the new company and would receive payments on that debt, including interest, which would be an asset for AT&T. The final possibility would be that the new company simply gives AT&T cash as a part of the transaction. I'm betting that they move the debt to the new company as that makes the most sense to me, but all three options are possibilities and could possibly even be a combination of two or more. That will all become a little more clear as we move throughout this year. Looking at the final 3 months of the year, we can see a large increase in share volume with a concurrent decrease in price. This usually indicates tax loss selling, since many investors would like to lower the taxes that they have on highly profitable sales by shedding some losers. AT&T certainly matched the loser description last year, having gone from $32 right after the Time Warner deal to $22 in December. I personally think the $32 in May of 2021 is a more reasonable price and will be reached again within a reasonable time frame. Looking at main rivals Verizon and T-Mobile, we can easily see that if AT&T just matches second place Verizon, there's considerable upside possible. If it ever gets halfway to T-Mobile, we could see a double from here. There's a lot of upside price potential in T, and that's not counting the potential in Discovery once AT&T shareholders own 71% of the new company. As many have mentioned before me, there have been long-term management issues with AT&T that go well beyond the poorly received Time Warner deal. The new CEO, John Stankey, is the former head of AT&T's Time Warner unit, but prior to that, his executive experience was exclusively with the Bell companies in various positions going back to 1985. In other words, his operational experience is as a telecom executive, not an entertainment executive. Hopefully, Stankey sticks to his telecommunications background and doesn't venture too far from what AT&T has done best for decades. AT&T has been beaten and battered the last year. Current stockholders are grumbling, and rightfully so, but the significant uptick in price since year-end may indicate that the turn higher has already begun and should go much higher by the end of 2022. Although the dividend is due to be cut post-breakup, it should still end up in the range of 5%. And that's not counting the Discovery part of the deal, which I think has great potential under the direction of John Malone. The market should realize the split is a positive for both companies, driving the price higher for both of them in 2022. And remember, you're going to own shares in each company, not just AT&T. Plan on capital gains for both of these stocks by the end of 2022. My personal opinion is that a purchase of T stock is currently best for dividend investors that have a time horizon of more than 5 years left until retirement, as there's still a lot of uncertainty. But if you fall into that category, I believe it's a solid play. If you found this video helpful in any way, I'd greatly appreciate it if you pop that like button and subscribe. Thanks for hanging out with me until the end. See you next time.